What if I told you that one of the most underappreciated assets on the planet right now isn't some obscure crypto token, isn't some tech startup, and it isn't buried in a complicated financial instrument that takes a law degree to understand? What if it's been sitting right in front of us, literally used in the phone in your pocket, the solar panels going up on rooftops across America, and the medical equipment in hospitals? And most people still aren't paying close attention to it. We're talking about silver. And today, we're going to walk through something that I think is genuinely fascinating and worth understanding, whether you own any silver or not. Because the structural story unfolding in the silver market right now is one of those rare situations where the numbers, the history, and the industrial reality are all pointing in the same direction at the same time. I want to be completely upfront with you from the beginning. This video is not financial advice. I'm not going to tell you to buy anything or sell anything. What I am going to do is walk you through the data, the history, and the logic so that you can make sense of it yourself. That's what this channel is about, giving you the clarity to think through these things on your own. So, let's get into it. Let's start with the basics, because before we can appreciate what's happening right now, we need to understand what silver actually is in the context of markets. Silver is what analysts call a hybrid asset. It lives in two worlds at the same time. On one side, it behaves like a precious metal. People buy it as a store of value, as a hedge against currency debasement, as a kind of financial insurance. On the other side, it's a highly functional industrial commodity. It conducts electricity better than any other metal on Earth. It's used in electronics, in solar panels, in electric vehicles, in medical devices, in water purification systems. And this dual nature is exactly what makes silver's situation today so unusual and so worth paying attention to. Think about it this way. Most assets are either financial instruments or industrial inputs. Silver is both simultaneously, and right now, both of those roles are pulling demand in the same direction, upward, while the supply side of the equation is struggling to keep pace. That combination is what creates what market analysts are calling a structural deficit, and understanding that deficit is the first key to understanding why serious analysts are putting out price targets that, to most people, still sound almost unbelievable. So let's break this down, starting with the supply side, because this is where the story gets really interesting. Silver doesn't come out of the ground primarily from silver mines. Most people don't realize this. About 70 to 75% of all newly mined silver comes as a byproduct of mining other metals: copper, lead, zinc, and gold. What this means is that silver supply is not primarily driven by silver demand. It's driven by the economics of those other metals. So if copper demand slows down and copper miners cut back on production, silver supply drops even if silver demand is surging. The silver market doesn't control its own supply destiny the way most commodity markets do, and that creates a structural vulnerability baked right into the foundation of how this metal is produced. Now, layer on top of that the simple fact that new large-scale silver discoveries have become increasingly rare. The easy deposits have largely been found and mined. The industry is working with more complex, deeper, lower-grade ore bodies. Opening a significant new silver mine from discovery to production can take a decade or more, factoring in geological surveys, environmental studies, permitting, construction, and all the regulatory steps in between. So even if the price of silver were to jump significantly tomorrow, the supply response would be slow. It wouldn't show up for years. This is critically important, and it's one of the reasons why supply deficits in silver can persist far longer than most people expect. Now let's look at the demand side, because this is where the story really accelerates. The industrial demand for silver has been growing steadily for years, and the growth engines behind it are not slowing down. They're speeding up. The single biggest driver that almost everyone who follows this market talks about is the global energy transition. Solar power in particular is absolutely voracious when it comes to silver consumption. Each solar panel contains a meaningful amount of silver. Silver paste is used in the photovoltaic cells to conduct the electricity the panels generate. And the world is installing solar panels at a pace that would have seemed almost fictional a decade ago. Think about the scale of what's happening. Countries across Asia, Europe, the Americas, they're all racing to build out solar capacity. The United States alone has committed to massive infrastructure investments. China is installing solar at a rate that is staggering. India is rapidly scaling up, and every single one of those solar panels needs silver. The Silver Institute, which tracks this data carefully, has reported that solar applications alone have become one of the largest single categories of industrial silver demand. We're talking about hundreds of millions of ounces consumed every single year just for solar, and that number keeps growing. Then you add electric vehicles to the picture. EVs use silver in multiple ways: in the battery management systems, in the charging infrastructure, in the various electronic controls and sensors that make modern electric vehicles work. As the global automotive industry shifts toward electrification, that demand pathway for silver keeps expanding. And beyond solar and EVs, silver is deeply embedded in the broader electronics ecosystem: 5G infrastructure, semiconductor manufacturing, consumer electronics. The whole digital world runs on components that depend on silver. There is no credible substitute that matches silver's electrical conductivity at a comparable cost and reliability level for many of these applications. So here's where we arrive at the core of the structural deficit argument. When you put supply constraints on one side of the scale and accelerating demand on the other, you get a deficit. And the Silver Institute's data has shown that the physical silver market has been running a structural deficit, meaning demand exceeds supply, for multiple consecutive years. We're not talking about a small imbalance. We're talking about deficits measured in the hundreds of millions of ounces annually. The gap is being filled by drawing down existing above-ground stockpiles, but those stockpiles are finite. You can't draw down inventory forever. At some point, the price has to adjust to bring the market back into balance. And the question is not really whether that adjustment happens, it's a question of when and how large it ends up being. Now here's where the second pillar of the silver story comes in, and this one is rooted in history. It's called the gold-silver ratio, and it's one of the oldest and most closely watched relationships in all of commodities. The gold-silver ratio is simply the number of ounces of silver it takes to buy 1 ounce of gold. If gold is at $3,000 and silver is at $30, the ratio is 100 to 1, and right now that ratio is historically elevated, meaning silver is historically cheap relative to gold. Let's put that in historical context, because this is genuinely important. Over thousands of years of monetary history, the gold-silver ratio has averaged somewhere in the range of 15 to 1. Ancient Rome legally fixed it around 12 to 1. For much of the 19th century, when the United States was on a bimetallic standard, silver was officially valued at a ratio of about 16 to 1 to gold. Even in the more modern era, throughout much of the 20th century, the ratio often traded in a range between 30 and 60 to 1. But in recent decades, that ratio has stretched dramatically. It surpassed 80 to 1. It briefly hit extraordinary levels near 120 to 1 during the financial stress of early 2020. And even at levels of 80 or 90 to 1, where it has spent significant time in recent years, silver is, historically speaking, deeply undervalued relative to gold. Now, why does this matter? Because historically, when this ratio has stretched to extreme levels, it has tended to revert, meaning silver outperforms gold, and the ratio compresses back toward more normal historical ranges. This has happened repeatedly across different economic cycles and different market environments. The ratio stretched and then compressed, stretched and compressed. And each time it compressed, silver made dramatic moves to the upside. The question every silver analyst is asking right now is whether we're at one of those inflection points again. Here's where the math becomes genuinely interesting. Let's walk through some simple scenarios, so this becomes concrete rather than abstract. If gold is trading somewhere in the range of $3,000 to $3,300 per ounce, and the gold-silver ratio reverts even partially, and not all the way back to historical averages, but just a meaningful compression, what does that imply for silver? If the ratio moves from around 90 to 1 down to 60 to 1, which is still not historically aggressive, silver would need to roughly multiply by 1.5 times at constant gold prices just to achieve that ratio. If the ratio moves to 50 to 1, still well above long-term historical averages, you're looking at silver prices that would be dramatically higher than today. And if gold itself continues moving higher at the same time, as many gold analysts expect given the current macroeconomic backdrop of persistent deficits, currency concerns, and central bank buying, then the math for silver becomes even more striking. Take any gold price, divide by the ratio you think is reasonable based on history. That's where silver would need to trade. This is why analysts who study this seriously are talking about targets of $100, $150, and some at the more aggressive end even higher. When you combine a structural physical deficit with a historically stretched gold-silver ratio that has a strong track record of reverting, those price targets start to look less like wild speculation and more like the output of a logical framework applied to real data. Now I want to pause here for a moment because I know what some of you are thinking. You might be wondering, if this opportunity is so apparent, why hasn't it already happened? And that is a completely fair and intelligent question. The first part of the answer is that silver has a reputation problem. It has sometimes been called gold's more volatile sibling. It made dramatic moves around 2011, touching nearly $50 per ounce, and then came down hard over the following years. That kind of volatility creates caution, even when the fundamentals are genuinely strong. The second part of the answer is that silver's industrial demand drivers, particularly solar and EVs, are relatively new in terms of the scale of their impact. Markets often lag structural shifts, especially in commodities, where physical reality takes time to translate into price discovery. The third part is that paper markets, futures contracts, and ETFs allow significant price discovery to happen without actual physical silver changing hands. This can temporarily dampen price signals. But physical reality asserts itself over time. When actual industrial buyers need to secure physical material and find supply is tight, they bid higher, and that physical premium eventually pulls paper prices along with it. Here's the midpoint of our conversation today. If you're finding this valuable and you want content that breaks down these economic and market topics without the noise and without the hype, it would genuinely mean a lot if you hit that like button and subscribe to the channel. It helps this kind of content reach more people. I read every comment, so if you have thoughts on silver, drop them below. Let's continue. Because there's another dimension to this story that doesn't get enough attention, the macro backdrop. Silver doesn't exist in a vacuum. The U.S. national debt has crossed levels that would have been unthinkable a generation ago. The interest payments on that debt are consuming an ever larger share of the federal budget. And the political appetite for meaningful deficit reduction is essentially non-existent across party lines. When the long-term purchasing power of fiat currency is in question, hard assets, things that can't be printed, tend to benefit. Gold has already made dramatic new all-time highs reflecting this dynamic. Silver, as gold's companion in the precious metal space, historically follows. Then there's the global central bank angle. Over the past several years, central banks, particularly in China, Russia, India, and across the Middle East, have been aggressively accumulating gold. They've been reducing dollar-denominated reserves and adding physical precious metals. This is not a small trend. It represents a meaningful structural shift in how sovereign wealth is being managed globally, and this kind of large-scale flight toward hard assets creates a rising tide that benefits the entire precious metals complex, including silver. Now, let's spend a moment on risks, because responsible analysis means acknowledging them honestly. The silver bull case is compelling, but it is not guaranteed. If the global economy enters a severe recession, industrial demand for silver could drop sharply, and that downward pressure could overwhelm even the structural deficit story in the short term. We saw something like this in 2008. Precious metals initially fell during the acute phase of the financial crisis before later recovering. If the energy transition slows down due to policy changes or economic headwinds, the solar demand story could develop more slowly than optimistic projections suggest. If major technological breakthroughs find substitute materials for some of silver's applications, that changes the demand math. These are real possibilities that need to be part of any honest assessment. The gold-silver ratio, while it has historically tended to revert toward lower levels, can also stay elevated for extended periods. Historical averages don't create binding timetables. A ratio of 80 or 90 to 1 can persist longer than even informed analysts expect, and patience is required when engaging with structural arguments like these. And silver is simply a volatile asset. Moves of 10 or 15% in either direction over a short period are not unusual. That kind of movement is not comfortable for everyone, and it's important to be honest with yourself about your own psychology and your financial situation before engaging with an asset that behaves that way. With all of that context established, let's build a simple mental framework for thinking about silver's potential trajectory. Think of it as 3 levers that need to pull in the same direction for the bull case to play out fully. The first lever is the physical deficit. Supply continues to fall short of demand, inventories draw down, and physical tightness starts to translate into higher prices. The second lever is the monetary environment. The macro backdrop remains favorable to hard assets, with ongoing currency concerns, elevated debt levels, and continued institutional interest in precious metals. The third lever is the ratio reversion. The gold-silver ratio begins to compress as silver outperforms gold, driven by a combination of investor recognition of the value gap and the industrial demand story gaining broader appreciation. When all 3 of these levers are engaged simultaneously, the price impact is not additive, it's multiplicative. The physical demand creates a floor. The monetary environment attracts investment flows. The ratio reversion adds momentum as investors recognize the relative value. This is the scenario that gets serious analysts to those $100, $150, and higher price targets. And importantly, the components of that scenario are all grounded in real, observable, measurable dynamics, not in speculation or hope. Now let's put the $150 target in historical context, because I think this is clarifying. Silver hit nearly $50 per ounce in 2011 during a period of post-financial crisis precious metals enthusiasm. At $50, silver was a real market price that real buyers and sellers transacted at. Take that 2011 price and adjust it for the inflation that has occurred since then. The inflation-adjusted value of that 2011 peak in today's dollars is meaningfully higher than $50. Some estimates put it well above $70 in real purchasing power terms. So a move toward $100 or $150 is not silver going to some unprecedented territory. It would be silver recovering its real purchasing power, and then some, in an environment where the demand fundamentals are actually stronger than they were in 2011. This is an important reframe. We sometimes see a high nominal price and think that sounds extreme. But when you account for the fact that the dollar itself has lost significant purchasing power over decades, the math on these targets becomes more grounded in reality than it initially appears. Here's what I want you to take away from everything we've covered today. The silver story is not a get-rich-quick pitch. It's about a real, measurable physical commodity facing a structural imbalance between supply and demand at the exact same time that a historically stretched valuation relationship, the gold-silver ratio, is sitting at levels that have historically preceded significant silver outperformance. Layer on a macroeconomic environment that is broadly favorable to hard assets, and you have a case that is worth understanding regardless of what you ultimately decide to do with the information. The $150 target is not a wild guess. It's the output of a specific logic. Identify a credible gold price based on current trends, apply a historically reasonable gold-silver ratio, and you arrive at a silver price in that territory. Some scenarios get there faster, some slower, but the framework itself is grounded in observable, verifiable data. What matters most is not the exact price target. What matters is understanding the structural forces at work, having realistic expectations about both the opportunity and the risks, and thinking clearly about how this fits or doesn't fit into your own financial picture. Precious metals are not for everyone. They don't pay dividends. They can be volatile. They require patience. But for people who understand what they're buying and why, the case for silver right now is one of the more interesting and well-supported structural stories in the commodity world. I hope this video has given you a clearer picture of what the silver story is actually about. Not the hype version, but the real version, with all its complexity and its legitimate uncertainty. The deficit is real. The ratio is historically stretched. The macro backdrop is supportive. The risks are real too. And the path forward is genuinely uncertain in its timing, even if the directional logic is compelling. If you want to go deeper on any of the topics we covered today, whether that's the mechanics of the gold-silver ratio, the details of silver's industrial demand, or the history of precious metals bull markets, drop a comment below and let me know. I read everything, and your questions genuinely shape what I cover next on this channel. If this was useful to you, sharing it with someone who's thinking about these topics is one of the best ways to help this kind of independent financial education reach more people. Thank you for spending this time with me today. I'm John Smith, this is John Smith Hero 2, and I'll see you in the next one.